Hello and welcome to Trades and Tutorials. This is Jeff Bish, president of MarketGauge.com, and in this video I am going to focus on a table and an indicator that is relatively new to most of you at Market Gauge, I'm sure. And if you're just finding us on YouTube, you've probably never seen this either. But it's the reason that I have been saying recently to members that the pullback in the market to the 200-day moving average by the S&P 500 is the most dangerous pullback we've seen since 2011. So this is kind of a follow-up to another video that I put out to members, and I'll talk about that in just a second. But before I get started, I want to just make sure that if you're finding us on YouTube, make sure you subscribe to the channel so you get these videos as soon as they come out. Also, I want to make sure that you know that you can see this video in HD if you're not seeing it in HD already by checking the settings in the lower right-hand corner. You'll see a little gear there, and you can check HD. The video will be a lot clearer. I think you'll like it a lot better. So let's talk about this indicator that's driving me to say that the markets are extremely dangerous right now. But before I make this sound like a scary things are going to collapse video, it's not. This is actually about being in a very good place as a trader, because we're sitting at the 200-day moving average, and as you're going to see in a second, there is a really cool way to determine whether or not the market is extremely vulnerable to further selling. And the flip side is you'll be able to see when the market is in a position where you could be buying when the market recovers from the 200-day moving average, which is a great time, especially if you're a swing trader, to enter positions. Now, I also alluded to the fact that this is a follow-up video. So I put out a video. It's one of two videos that have gone out so far in a series of instructional videos that I'm putting out this week. And I'll put a link to that series. If you're not already in on it, you can click on it in the text. However, if you're seeing this video in the future, then you may have already missed that series of videos. I apologize, but this one's a good start as well. So I have to start with the basics. So someone wrote in and said that the numbers that they saw for our 6-month change were not the same. Actually, I got to start further back. Where am I? I am in the Little Big View section of our website. This area is completely free. If you go to Resources, then go to Little Big View, and then go to Sector Summary. And you're going to find a table, the one you see right here, that has lots of great information on it. I'm going to focus on really just one column here, this 6-month change. All right, so if you got the free report that was part of this information training that we've been putting out this week, this is that 6-month change right there. It's a great place to start to find leading industry groups. And it is a great barometer of whether or not you want to be in or out of an industry group. And it all starts with a really basic concept of, who is the strongest in the last 6 months, and focus on that one group. And if that's all you did, you can really put yourself in the right place very easily. Now, the other thing we're going to talk about in this video is looking at how many are positive, right? So this is a key number to watch. So right now we have 1, 2, 3, 4, 5. Now the other thing that I look at is how positive. So you can see that XLP here is just marginally positive. So that's something to keep in mind because the magic number, if there is one right now, is 3. We want to see 3 positive. And if we have less than 3, that is real reason for concern. And to fast forward, if you have less than 3 and you're trading under the 200-day or the 40-week moving average, that is really negative. And that's the problem, right there in a nutshell. You can see that we've got a situation right now where the SPYs, the S&P 500, is trading right at the 200-day moving average. And this particular industry group here only up 0.2%, could easily flip negative on any given day, and then that leaves us with 4, and I'm telling you to watch out if there's only 3. And the next one here is only up 3%, so that one could fall 3% over a couple of days, and pretty soon we're down to that really scary place for the bulls. All right, so that is, and I'm going to show you in a chart. I'm going to show you what this means in a chart. But before I do, I'm going to rewind for a second. And there was a couple of good questions that came in. One of them was someone, and I apologize, I don't remember your name if you're listening to the video, but I'm going to try and make sure you get the video. Was saying that they were looking at XLV on their Morningstar charting, and they were getting a different number than 8.6. So many of you could possibly get a different number. Our 6 months here is 130 days, trading days. Okay, so if you're looking at a calendar, which is what this person was doing, and saying, well, it's July 6th, I'm going to go look at January 6th, and that should be 6 months, and I'm not getting the same number. You're not going to get the same exact number. We're looking at a way to calculate 6 months. It's based on a fixed number of days, and obviously different months are going to have slightly different number of calendar days. But this is kind of like a 200-day moving average is the last 200 trading days. So we're looking at the last 130 trading days. The way that you were looking at these particular numbers for the purposes of market analysis, you know what, it's really not going to matter if this was 8.6 or 6%. Yes, it would matter. It might matter from this being positive or negative, but this is not a precise science. All right, it's fair to say close enough. All right, and that's why I'm pointing out that you need to kind of look at the numbers and look at them with a grain of salt. Don't go crazy over the markets going from okay to extremely bearish, all because of a 0.2% or a 0.3% in one particular industry group. Think about it. That's just not reality. We're looking at big ebbs and flows here. So the big picture is that we're using 130 days. So if you find a little discrepancy, don't worry about it. So the next question I'm going to get to in a minute, but I'm going to tell you ahead of time what it was. And it was someone had paid attention to the video, and for that I really commend you, and was saying, well, you really didn't tell us what to do when it's time to buy. And so you're right, I didn't tell you that. It wasn't that I meant to leave it out, it's just that wasn't really the point of the video. But I will get into that in this video. So we're focusing on the 6 months change. You can find it at the sector summary. It's updated at the end of the day. And essentially, I could boil it down to focus on the strongest 6 month leaders. And right now, in the current market conditions, focus on the ones that are still positive. Now, what about the overall market? So the overall market, I'm going to show you the chart in TradeStation. But the other thing that you should know is that every week, I will put the weekly chart right here. So this is a weekly chart, and that's why I said 40 weeks. Also, because it's a weekly chart, this is as of last Friday. I suppose I should probably put that up here. As of last Friday, it was 7. Now we are at Thursday, the end of Thursday, the following week, we're at 4. So I'm going to go to my TradeStation. I'm going to show you this live, but you can see this indicator again for free on this particular web page. So let's take this off for a second. And I've got the weekly here just to kind of illustrate what we're talking about. So the weekly over here on the left is what you're going to see on the website, and I'll show you why in a second. And the daily, this is what it looks like right now. So I guess we're at 5, not 4. We're at 5. All right, so that's the difference in the two charts. Now the reason that I'm showing you the weekly is, or printing out the weekly, is because it gives you more perspective on the long term. All right, so Here's what you need to watch out for right now. The markets are trading under their 200 day, or I should say the SPY is trading under the 200 day. Now this would be more dire if we had the other major market indexes doing the same thing, but that's beyond the scope of this particular conversation. If I zoom down into the daily here, one of the things that is now concerning with today's close is now you've got two closes under this 200-day moving average, which is still positively sloped. So it wouldn't be unusual to see it spend some time here. But if it continues to extend lower, and this continues to be this low, 4 or 3, that's not good. I mean, that's a break that you want to respect on the downside. And if by chance over the next couple days the industry group number down here goes to a 3 or a 2, the lower this thing gets, the more of a warning being under the 200-day is. All right, so I kind of glanced over the fact, let me make sure everybody's following here. This green line here is the number of green industry groups relative to their 6-month change. Okay, the red is the number of negative ones. So we got about 7 negative here and about 8 positive. That doesn't make sense because I think we're looking at 14 total. But you don't really have to worry about the red. If you just worry about the green, the red's going to be the opposite. It's going to be 14 minus whatever you got up here. Okay, so the micro analysis of this is too many closes under the 200, a break of a new low. Where is your industry group kind of strength here? Do you have your industry? Do you have some industries holding up, or are they just all now falling into negative territory? And if they're all falling into negative territory, then you've really got some momentum behind the downside here. Now let's go back and look at how this has played out over time. That's where we go to the weekly. So if we take a look at what has happened since the market started rallying, when it pulled back to the 40-week here, look, you had like 12, maybe 8 industry groups that were positive, right? When you pulled back here, you were still well into the positive territory, and this little pullback here, well into positive territory. You had the majority of the industry groups were up, and even I know we didn't pull all the way back here, but believe me, from here to here in 3 weeks didn't feel very good. But if you kept it in perspective, it was strong. All right, here the market breaks down pretty significantly below that level. Industry groups remained strong. But now let's look at what's happened over the course of the last several months. Right, the markets have sold off, but the groups have really sold off. Now, in all fairness to the analysis, remember what we're looking at is a 6-month change. So because the markets have gone sideways, it's a lot easier for this to happen, right? So I'm sure there's somebody out there, because that would be me, saying, oh yeah, of course it is, because we've been flat. It's not going to take as much to make these things negative as it would have here when everything's been going up, right? To get 6 months negative from here, you'd really have to have a bigger pullback. That's true, but the nature of markets is that when they're in an expansion phase, they can pull back and recover much easier. When they have consolidated, when they begin to break down is when they become really dangerous, right? So this is consolidation. If you're a bull and you see all this consolidation and it's breaking out to the upside, you get all excited because that's what powers markets. Well, the same thing is true on the downside. So all this consolidation and then breaking down is dangerous. And if it's happening in a whole bunch of industry groups, which is what we're calculating here, when I say a whole bunch, I mean now they're now going down, not up. That's what makes this dangerous, okay? Now, I said that this wasn't all about being fearful. It's actually the flip side of this, and this is the way I'm hoping in putting out the information that I'm putting out this week that what traders will realize is that the sell-offs really can be an opportunity. You just need to look at them from the standpoint of this is a negative, potentially a negative period right now. I need to identify when the negative turns around and becomes safe or becomes a positive. So how does that relate to this indicator right now? If we continue to move lower, and we stay under the 200. Actually, it doesn't even matter. Let me go to the daily. With the weekly, we've come down to the 200, and if we start moving back up, it's going to be potentially a really great opportunity. How great? I'll show you on the daily. You'll be able to see it on the weekly as well, but the daily I think is easier for demonstration purposes. So, and in fact, let's go back to this one. This thing cut through the 200-day here like a knife, but the groups held up relatively well. So when it was down here, it would be aggressive to say, well, you know what, the groups have held up, I'm going to be a buyer down here. Now you certainly could do it, and you could certainly do it on an inside day, and there's plenty of tactics that you could do to get into it. Those are beyond the scope of this. This particular video is focusing on really, let's take it high level, keep it simple. As long as you go back over the 200-day, then you start getting interested in being long. And if you've got strong groups, those are the 200-day crossovers that you want to focus on. So the opportunity here is that the market, it has started to pull back. I could draw it like that, but I'd really draw it like this, and this is how I've been pretty much positioning the condition of the market with our members, which is, here's your low, right? You don't want to take out that low on a price basis. If you do, the market's in danger. But if you get back above this, you've got some nice consolidation here that could power this thing back all the way up to the top of the range pretty quickly. Now, so far, we're not on the right side of that line. Once you've pierced that line and you put in a reversal like you do, you move the line down. That's why the 204 levels is so important here. So if the market starts to move back up, for more than a day or 2 days, and your groups remain, let's call it 5 or better, even better would be if this starts to move up, then you know that this breakout here is one that's worth buying and looking for a stronger move higher. Now that's if it happens right now. The other thing that could happen over the next couple weeks is this could really flush out, continue to move down. I'd be willing to bet serious money that if that happens, this is going to turn negative, and that's going to put us in a situation where we really want to wait for the market to come back over the 200, at least the conservative ones. I'm saying conservative because it would take me a lot more time than a quick video to tell you how to buy it down here, but we do help with that too. Different time. So you wait for it to come back over the 200 and the groups to be back above the 3 level. So there's the opportunity. Whether that opportunity happens, this week because the sentiment in Greece and China flips around and everybody gets excited, then you can focus on this 208 level, breaks out with good groups, you're good to go. If it continues to go lower, be careful. All right. I hope that I have made the impression. I feel like I'm repeating myself, but you'd be surprised how many times it takes to get everybody to hear the same thing. This situation right here is not the same as this situation right here. Can you see that? All right. If this moves down, it is very likely that these groups are going to get even fewer, and that means that the underlying strength of the market is not the same here as it was here. And that's why I'm saying since 2011, we have not had a break of the 200 with weak groups. All right, when that happened in 2011, the market got a bit smashed and in fact stayed down for some time. And this one doesn't go back that far. All right, we'll look at it on the weekly when we come back. All right, so that's the opportunity or the danger. And I just wanted to put that out here so that you know, because I think it's really timely. It's an indicator, which is on a weekly basis, which is what you're going to see going forward, that you can get for free. And it's incredibly powerful. No one else is looking at it this way. So you've got an edge here. And so let's go back in 2011, and then I'll wrap it up with what to buy when it goes back above the 200, which eventually it will do. You just have to be patient. So in this case, we break down. This might have been right here, so the breakdown you might not have caught, but the next week things were terrible. All right. So if you're on a daily basis, this was all falling apart intra-week. All right. You would see this in the chart that we're providing with you. You see it in the table. But my point here is that this break, for the first 2 days, doesn't necessarily look any different than the break we were just looking at that came roaring back. But on the groups, it's completely different. And after 2 or 3 days down here, you can see that, or weeks, you can see that it's not recovering. All right. So this is a weak area that is extremely risky relative to a situation where, let's say, look like this, where you've got groups that are much higher, or like this, where the groups are much higher. In this case, when the market rallied back over the 40-week, the 40-week, which you could argue could have looked just like this, it spent another 2 months trying to get back through. And in both cases, once you break both the 40-week and you've got good group, break the 40-week and you've got good groups, you've got weeks, months of upside. All right, so from a big picture point of view, don't try to time this to the hour. Probably don't even try and don't time the groups part of it to the day, but you could time it to the week. All right, so once it gets going, then you know that you've got that edge of the group rotation, so to speak, on your side. All right, so now the second question that I had that I said I would cover from the trader who wanted to know, well, which groups are you going to buy? Are you going to just buy the strongest one? The answer to that is, well, if you get the free report, the answer is yes, you just buy the strongest one. But the free report was all about the fact that if all you did was have one position, make it the strongest one. And just being in the strongest one has its challenges if you're only in one. So let's not limit ourselves to that. The idea here is if the market heads back over the 200, more confirmation will be back over the consolidation around the 200, then which groups are you going to look at? The next thing I'm going to do, if that happens, is look at this table. And when we look at this table, we'll see XLV is really healthy, XHB really healthy, XLY really healthy. They're all up 6, 8%. Even XRT 3%. So if you've got stuff that looks decent on here, that's where I would look first. The next thing you're going to want to look at is where they stand perhaps relative to their phase. I'm not going to go over that right now. I may put out a video in the next week about phases and using it with this. I can't be 100% sure. But look at their phase. So along those lines, let me pull this out. Do this. I'm going to take a look at these groups. I'm going to look at XLV, XHB, consumer discretionary, retail, XLP because that one's close. XLK I can tell you because it's distribution, which means it's under the 200. This thing's gotten this one does not look good, partly because Apple's just getting hammered. And let's take a look at financials too. All right, so what am I saying? I'm going to look at the top groups first. I'm not going to look at these bottom guys. All right, they're definitely not going to buy those because of any kind of relative strength rank system. All right, so let's just take a look at those quickly, and then I will wrap this up. Didn't think it would be this long. Where did I? We can use this chart. All right, I'll use this chart. And the last chart that I was showing you, which sorry I didn't mention, the 200-day was the blue line. The green line is actually the 100-day, and the magenta was the 50-day. So I didn't plan this out well, but the colors here have slightly changed. So the gray line here is the 50-day. The gray line is the 200-day. The 50-day is the magenta line. That's consistent. And the green line is the 10-day here. I also like to look at the 100-day moving average, but I'm not going to put that on the chart right now. So let's just take a look at the first one on the list, which was XLV. So let's say that the markets went back above the 200-day today. What would I look at? Well, I'd look at the strongest one first, and I'd see that the XLV has actually been holding its 50, not the 200. So this one's holding up really quite well. And if it were to turn around and take out the 10 and move higher, then I've got a really good swing position here where I'm trading over the 10 for the first time in this whole consolidation. And big picture is it really shouldn't trade back down below this level. All right, so XLV would definitely be one I'd try and time my way into. All right, more specifically, I can't get into in this particular video. XHB has held the 50 great. All right, so this one looks great, and in fact, in our ETF models, they like this one too. So I definitely have a bias towards this one. I'll tell you one thing that jumps out at me with this is that here is a kind of the breakdown from last week. This one's actually holding that breakdown. So this one looks great. If the market turns around here, this would be one of the first places I would look, especially over that number. All right, then consumer discretionary. Let's take that. Now all I'm doing is going down the list from the strongest to what becomes negative. So this one isn't nearly as strong as the other ones, right? But it still doesn't look all that bad vis-a-vis its 200-day moving average. Puts it much stronger than the overall market, but I'd have to find a good looking pattern here based on when the market moves. So I don't have, this one isn't as obvious in terms of where to get in, but again, that 10-day moving average is going to serve as a good benchmark for a turnaround. A turnaround meaning move back up to the upside. XRT. This one really tried hard to get going today, and has been fighting to get over this 50-day, but the big picture here is that it's held up much better relative to its 200 than the overall market. So if this one were to continue to move higher, or even find my way into a position with probably a stop based on average true range, just to get in, again, assuming that the reason you're looking to get into these is because the general market has told us it's time, it's a good time to start looking to enter some positions. So that one looks pretty good too. Now XLP is the one that's only up 0.2%, right? But this one actually on a 50-day and 200-day looks almost the most interesting. I still think XHB looks the most interesting, but this one looks just as interesting, especially if it could break and move higher than this swing high here, right? So of all of them, this would be the only one that's actually taking out a swing high if it moves higher. So above this level would look great with a stop below a daily low. All right. Again, when would I do this? I do this when the market's telling me that it's time to move higher. Not right now. Right now, it still looks tentative, right? We got to see the market back over the 200-day for a couple days and be looking higher. All right, so that's everything that's positive. Let's just take one look at XLF. XLF was one of the negative ones. Sometimes I would look at the negative ones to see if there's anything that will look good if it turns up. And XLK, that is not one of them. That's not XLF. So XLF looks interesting. All right, if it can hold, and the reason it looks interesting is because here's last week's lows, and it's held them. That's exactly where you'd want and expect a market that rallies and then comes back and holds. So if it holds in here and then moves higher, I like XLF. Like it a lot, actually. All right, one last thing. We have 14 sectors on this particular list. There are a lot of sectors. There's a lot of different ways to choose your sectors. The idea here is to have a good variety of sectors. So could we add one and would it make a difference? No. Could we subtract one and would it make a difference? No. So an example of that is IBB is not on here, biotechs. No particular reason, nothing against IBB. When we put it together, we just didn't include it. But when you see XLV up at the top, healthcare, then you might want to look at XBI or IBB, two biotechs. Right now, I happen to be, or even Cure, but Cure is leveraged. So I happen to be partial to IBB because I've been in IBB a lot over this year because it's been one of the best performers, and I'm currently in it, still in it. And in part, XLV looks great, so I look at IBB. And IBB is one that I would absolutely pay attention to. Again, I'm biased. And if it breaks above this level, it's going to be over the 10. After a strong day today, it's held these levels of support. And so that's one I would look into. So there's kind of a long answer. I hope the person who asked it gets to see this video. That's how I would approach the market turning higher. I'd focus on the top ones. I'd look for patterns in the daily charts, in the weekly charts that give me good trade entries. Those patterns, look, I'm happy to help you with those too, but can't do it all in the video. This is already a 15-minute video that I've turned into a 30-minute video. So I hope you stuck around for the whole thing. Hope you found it helpful. Hope you're finding all the other content that we're putting out this week helpful. Please look at it this week because it will not be up forever. Again, if all this new content talk is new to you, I will put a link on this blog post somewhere. If you're seeing this on YouTube, go to marketgauge.com/sectors to get to the page that you're looking at right now. All right. Hope that helps. I'll see you in the next video.